The Prime Minister has announced a $6.3 billion so-called affordability package that includes temporary relief from the federal sales tax on selected items and a one-time $250 cheque that will be sent to more than 18 million Canadians who worked last year and earned $150,000 or less.
Inflation is down. We're back down. We've been close to a year within the target range that the Bank of Canada set, which is why the Bank of Canada is now dropping interest rates faster than for most of our peer countries. And it allows us to make sure that we are putting money in people's pockets in a way that is not going to stimulate inflation, but is going to help them make ends meet and continue our economic growth.
Let's get perspective from Brent Joyce, Chief Investment Strategist at BMO Private Investment Council and BMO Private Wealth. I'm sorry. He is Chief Strategist at BMO Private Investment Council and BMO Private Wealth. I was messing with my microphone there. Sorry, and it's great to see you.
Good to be here, Andy.
So, I mean, this is borrowed money. If we look first at these $250 checks, he's paying us our own money and he's borrowing it. Are you impressed here?
No, not impressed at all. Who comes up with these names, right? The Inflation Reduction Act in the U.S., the affordability. Who can afford? The government can't afford this. But that aside, this patchwork, piecemeal, clearly politically motivated, it has implications for inflation. It has implications for Canadian economic activity in the near term. What's interesting is the bond market's reaction. And so you hand out money with the one hand, but now we're raising borrowing costs today for Canadian businesses and households in the bond market. Right, so there are consequences to these choices.
That's interesting. Yeah, so let's maybe put up the Canadian 10-year yield and see. So you think that the bond market is saying this is inflationary?
Well, it's inflationary, but it's a question of, is this the tip of the iceberg? So if this is a political ploy to get the logjam out of Parliament out of the way that's been shut down for 2 months and get the NDP to glue back together the supply and confidence deal that apparently they tore up but doesn't appear to be, then maybe we're all right. It's not a huge impact. If this is the tip of the iceberg and what's heading into likely an election year and there's more spending goodies to come, then the bond market, like we've seen in the U.S., is going to react to, well, that means the Bank of Canada maybe doesn't lower interest rates as much if there's fiscal stimulus, and then look at the fiscal picture in Canada, which is much, much better than the U.S., but at the margin, bond yields are higher on this news.
We're still running a deficit of maybe 40 billion or more. We're going to hear actually at around 4:20 Eastern time from Yves Giroux, the parliamentary budget officer, and he says, yeah, I think they've blown their promise to keep it to 40 billion. What about the GST cut? I know the Chartered Professional Accountants are saying this just creates a headache for companies trying to calculate it.
Right. And so, the location today at a grocery store in Mississauga, touting small businesses, it's a headache, right? When we go with this piecemeal patchwork approach to handing out political goodies, it doesn't look good.
We were joking before the show. I mean, shoes. So kids' shoes, the GST comes off. What about women who come in with small feet,
Good question.
pretending they're buying them for the kids, or board games and puzzles? Yeah. They're taking the tax off for 2 months.
Yeah. Everybody, loves a tax cut, but when are we going to get serious about the bigger issues around productivity?
Give us one or two things we got to do in that area.
Well, things that we should stop doing, right? Piecemeal pieces like this that don't do anything towards improving productivity. Let's spend that $6 billion somewhere else on investment. And then things that raise taxes with the capital gains tax, that's going to impede productivity growth as well. And so it's this stop-start, raise taxes over here, then hand out some goodies over there, with not a huge coherent strategy, it appears.
Give us your thoughts of how Canada can navigate this Trump presidency. You think we're in a fairly good spot when it comes to tariffs compared with a lot of other countries?
Yeah, a good spot compared with a lot of other countries is the key emphasis there. If you think about the Canadian economy and then the Canadian stock market, they're not the same thing, so that's an important differentiation. Canada was absent in a lot of the language during the campaign, and so hopefully we're flying under the radar. We've got this Jamil Javani fella that's bros with J.D. Vance, so who knows what comes of that. But as investors, we think about the TSX and the big behemoths there, energy, materials, and financials. Americans like cheap gas. And so the notion that we're going to see tariffs on oil, I think, is probably one we don't have to worry too much about.
Okay.
Metals and materials space, you had a big segment here about nuclear energy renaissance, right? We've got lots of critical metals that the Americans need, both strategically and for that on the energy piece. And then the financials. And beyond financials, however, manufacturers and businesses that are doing business in the United States. So branches of Canadian banks that are open in California and Chicago and the Carolinas, they're not going to experience tariffs. Operations of Canada Life, Sun Life, Manulife in the U.S., of which they're large, they're not going to experience tariffs. Tim Hortons, in New York City, no tariffs. Dynamite's shops, garage, et cetera, that are operating in the U.S., there's not going to be tariffs there either. And so big chunks of the TSX, Canadian businesses, big U.S. revenue, the dollar's adjusted. And so now you get those greenbacks convert to loonies to report your Canadian earnings. That's a boost. So it's all of that combined sort of, let's fly under the radar if we can, be realistic, and let's not get too emotional about what it means for us as investors. Canadian economy, we're going to have a different discussion, but certainly when we think about companies listed on the TSX, there's a lot of moving parts. And at the end of the day, what does Trump want? If you're going to sell to Americans, set up shop here in America. Well, for many, many Canadian businesses, we've already done that. We're already there.
Finally, Goldman made a call that made headlines a little while ago, saying over the next 10 years, we might see only a 3% annual return from stocks. And apparently, they're not talking about inflation adjusted. That's very low. And you think that's too pessimistic?
I do. The math, if you dig into the report, the math is legitimate. This has happened in the U.S. If you go back 80, 90, 100 years, there's been 3 instances where this 10-year rolling rate of return for the S&P 500, was below the 3%. The Great Depression is one, middle 1970s, very briefly.
Yeah.
And then we had one more recently in sort of 2007 to 2015.
Right, yeah, and the market, I'm trying to think, the market bottomed there in 2009.
Right.
Yeah. I think that represented a decade where there'd be no returns. But, that's very rare. Anyway.
It is.
Yeah.
All of those episodes coincide with market that had run up a lot. And so people are saying, are we checking that box today? And we can debate whether that is the case broadly across all stocks. I would say no. Certain sectors and certain businesses, yes, there's some froth there. But then there was some calamity. And this Goldman report talks about the fact that there would be a calamity that has to happen to cause this. And then they're pretty silent on what that, calamity might look like. And so, it's 9% of the return observations are below 3%. We'll lay our money on the other 91% of the outcomes.
Thank you very much, Brent. Brent Joyce.